Hello, everyone. I hope everyone's doing well. And thanks for joining us on this Sunday afternoon Eastern time, morning Pacific time, and evening for those of you joining from Pakistan or different parts of South Asia and East. I forget what time it is in East Asia, but evening in South Asia at least, and Pakistan. I'm glad to be hosting this and moderating this conversation with Paklaunch. I think it's a very important topic. Lots of stories starting with last week's events at Silicon Valley Bank. And just before I joined this webinar, I was just catching up on the fact that we have more stories coming out of in terms of the UBS Credit Suisse developments, etc. So essentially, some of us were following the Fed raise hikes, raise rates a lot in the last few weeks and months, and clearly the financial system around the world is creaking as a result of that. So we're going to be talking about what the Silicon Valley Bank's developments mean for the tech ecosystem writ large. And the way we're going to conduct this conversation is, have our wonderful panelists just share a bit about what they see happening and what's top of mind for them. And then I'll have a couple of questions to tee us off, but then you should ask some questions along the way as well. I'll just quickly introduce the panelists and the speakers for this conversation in order in which they will speak. We'll start with Salman Ahmed, who's based in London, global head of macro and strategic asset allocation for Fidelity International, which is one of the largest asset management firms globally. After that, we'll switch to Yousuf Khan, who's a VC in San Francisco, partner at Ridge Ventures, which is an early stage VC fund based in the Valley. Following Yousuf, we'll have Bilal Zuberi, who's also a VC in the San Francisco area, general partners at Lux Capital, which is a $4.5 billion fund based in the Valley as well. And then finally, we'll have Ahmed Jalal, who's an investor in the MENAP region, and founder of Cordoba Ventures and Zambil partner, former Goldman Sachs. And so we'll have Ahmed sort of share with us what this all means in terms of the region and emerging markets in particular. So with that, Salman, maybe I'll hand it over to you. And thank you for taking out the time. Help us understand what's happening at the macro sort of level, right? Because there's obviously been this long conversation. I've been speaking with you and listening to you speak on this as well in terms of inflation, higher rates, and all of a sudden the banking system seems like it's not liking what the Fed has been up to. So help us understand what's playing out in the macro space and in terms of like what central banks are doing around the world.
Thank you, Uzair, and thank you very much, everyone, for joining. So, I guess let me start with what is happening right now, and then we can take a step back in terms of charting out, what are the sources of these shocks. I'm sure there will be a lot of debate and discussion once this crisis settles down, hopefully. Just now, the news has come in that UBS has bought Credit Suisse and wiping out almost entire their equity, which is good news, at least that credit the CS credit will be protected. So I can explain a little bit the relevance and importance of that. So right now, what we are facing is a trust shock. This is very different from 2008, 2009, which was a confidence shock as a result of potential credit losses. This is a trust shock driven by the tightening in interest rates, which was the second largest tightening in terms of pace and magnitude since the 1980s. We as a house and myself have been flagging that this for a couple of years, that this is a very dangerous development because debt to GDP ratios are so high and the system may not be able to cope with this kind of aggressive tightening. That said, of course, the key central banks have been focused on inflation and the massive misallocation of resources which happened after COVID shock, which was done on the basis that interest rate will probably remain low and zero forever. So there was a massive misallocation of resourcing which happened both at a macro and micro level. And now this is showing up in unexpected ways, but ultimately through this trust shock, as I mentioned. So with SVB, of course, lots have been written now by now on the idiosyncratic issues which were prevalent in the bank. The problem with banking sector is that it's a systemically important sector. So I say that in a provocative sense, but if Facebook gets wiped out from the face of the planet overnight, nobody will care from a macro perspective. I mean, your money is not locked into, say, Facebook. It's just that you lose your network and you can, populate another one in coming days. That's not how banks work. So even though there were some idiosyncratic and mismanagement issues with SVB, the problem is that it creates a trust deficit in the whole sector. And that triggered another idiosyncratic story in Credit Suisse, which was under pressure for a while now due to mismanagement and other things, and then more generally on the regional banks in the US. So the idea is very simple. If you are a depositor above 250K in one of these banks, why would you take the risk of keeping your money in those banks? Yes, the Fed has and the FDIC have come in and given them liquidity and protection ex post, and given you a cocktail of acronyms. But apart from the wholesale market in finance, really nobody understands exactly how this bailout works. If you do, put a haircut on it, because it's a very complicated subject, and it's difficult to calibrate, and a lot of that is done through leverage, and confidence is the key behind it. So no bank can sustain deposit runs, so bank runs. So there were a lot of bank runs in the 1800s in the US. And that's why FDIC came into being. Then Federal Reserve came in after the global, the Great Depression. So there's a whole history behind trying to secure banks and making them more, stronger. So zooming out and taking a few steps back, as I mentioned, this inflation fight, which was important, but was done in a way which ignored the financial stability risks of tightening so fast. Our view is that we are already in that territory where this will do a lot of damage, because this tightening was done on planet Earth, not on planet Mars. So somebody will have to pay the price for it. And there's a lot of losses sitting in the system as a result of the increase in interest rates. The question is who realizes the loss and who explains it. And then, and in this case, there has been a bank which triggered a deposit run. So this is not by no means over. The only solution to my mind is an unlimited deposit guarantee, which the regional banks are starting to ask to stabilize that confidence and that trust back into the system, because it's fundamentally very different from 2008, 2009, when you were talking about credit issues and NPLs. This is more to do with losses coming from what you have in your what you call trading book versus what you have in your hold to maturity books, which are backing these liabilities when you look at the bank balance sheets. So all in all, we need government backstops which are unequivocal. Unfortunately, this time around, this is not the wholesale market which is involved, where the Fed can give liquidity like it has, because the discount window usage is gone through to $300 billion, and overall Fed has expanded balance sheet by $500 billion. Us on the wholesale side can see it, but I'm not quite sure that will stabilize the sentiment of the person on the street who would, can electronically transfer money out of the bank in seconds. So this electronic banking technology is also a challenge right now, because it can create a run within hours on some of these entities. So the speed is an enemy here, because it doesn't allow stability to come into play, and that's why I think a clear-cut, unequivocal protection for the depositors, which has its own issues like moral hazard and others, would be needed to stabilize confidence in the banking sector, especially in the regional banks in the US. Last point I would mention, I'll go back to you there, is more generally on asset markets. The transmission channel is now on credit tightening. So we are expecting credit standards to tighten quite significantly. We do expect investors to become very clear and very focused on what works and what doesn't work. and the penalties will be much higher, both from a risk premium perspective, and also this idea that you are passing the parcel, especially in some areas of the market, that may start to slow down as cost of funding rises and access to funding becomes a problem. So that credit standards loan survey data is very highly correlated with the bank CDS and bank share prices. So we're expecting a significant credit crunch to come through as a result of this shock, which is yet to play out fully, and it will a lot will depend on if the political environment in the US will allow this overarching backstop to come into play to restore trust back into the system. So I'll pause here and give the floor back to you, sir. Thank you.
Thank you, Salman. And I think, as you said, it's by no means over. And I think the political cycle obviously is already playing into this. There are already questions here, at least in Washington, where I am, being asked about some of the Trump era regulations that were done away with and their impact and all of that related to the broader political cycle here in Washington as well. So lots to chew on, even on the political side here as well. Yousuf, I want to bring you into this conversation here in terms of what you have seen play out in Silicon Valley and in terms of the VC space in particular. Obviously, SVB, even here, a couple of my friends who work at startups when this all went down were not sure if they would make payroll at their startup, right, coming out. And then there was the most fascinating story that I read about was not only startups that had their own money in SVB, but there was a payroll provider that had money in SVB, and then that had a second and third degree impact in terms of startups exposure here as well. So help us understand, what have you seen in the Valley, and what is top of mind for you?
Yeah, no, I think, look, it's been a character building last couple of weeks, if I'm perfectly candid. I think people, just to level set, I think it's important to get the kind of full context of kind of SVB and kind of how integral it has been in the tech ecosystem. The bank itself grew over time, so it's not just in Silicon Valley. It actually has a sizable operation in the UK. It basically had operations in Boston and other parts of the US. And it was very favorable towards early stage companies. Yes, majority in the technology era, but actually because of its geography, it actually impacted a number of industries across. So you heard industries like in Northern California is very rich with wine country, wine producers banked with Silicon Valley Bank, and they were ultimately impacted. So the impact of a bank run, it's this kind of notion that it's kind of centered around Silicon Valley is not correct, right? It actually has it has an impact. Any bank run in any industry at any time has a much wider impact. With Silicon Valley Bank, it was specifically, of course, to technology companies and a lot of venture funds which had banked. Silicon Valley Bank also had an asset management operation which invested in venture funds. It has an investment banking unit, which is now in Chapter 11. It has a healthcare banking practice as well as an investment bank. I mean, it's quite wide. So the impact of any bank run, and most banks will have a pretty wide portfolio unless they are very tightly focused in a specific area, which doesn't make them really, a bank run on those is not as widely felt. So it was widely felt here, number one. Definitively, the topmost concern for largely startups was, and growth companies, candidly speaking, was payroll. I mean, the payroll provider, it was not just one, it's several payroll providers which had integrated and built out a system with Silicon Valley Bank. And that was, one thing to note is when it comes to regulations, the system has to basically work. So the issue with the payroll piece is that there is legal implications on that. The legal implications about meeting payroll, it doesn't matter what the cause of the default is. So the moment you have that, there's a downstream impact for, therefore, people who are, struggling, being able to actually sue their employer, and there's a legal risk that goes with that. Now, irrespective of the cause. That's kind of one of the biggest issues that a number of people were concerned about, as well as ongoing operations. It was interesting to, for example, see that how well connected it was. So we would have vendors who had banked with Silicon Valley Bank who would tell customers of early stage technology companies or technology companies not to pay them, because they were like, well, we are still trying to organize, alternative bank accounts to be able to make sure we furnish. So it is wide. I think what's happened now, I mean, I agree. I think the aspect of the stress test system that was basically brought in post 2008, wasn't perfect by any measure, right? But I do think that is definitively required. This is kind of the first bank run. And I think the other thing is there's not really been a playbook for this, especially in the venture ecosystem. It's not something we've seen. We've seen, a financial crisis which affects a macro, and in last year, a large part of that was centered as a result in public company valuations, and therefore valuations that come into place at early stage, which is, specifically where I focus on. So you'll see, we've seen some correction there definitively. But the other thing that sort of comes into place is there was no particular playbook on this. So I think there's two things that have happened. One is that there's cash management policy, and being able to actually, have that in place is probably going to be a much bigger focus for early stage companies. Number two is there has been a stress in the system now as a result of it. So contagion, unfortunately, this is just part of, human reaction and perception to issues. So when people started moving their accounts to First Republic, or a whole bunch of entrepreneurs who said, I'm back with Silicon Valley Bank, I'm with First Republic. Now First Republic is having, kindly speaking, perception and issues. So it had to get a major influx of deposits from the larger banks. So my hope is that there is a degree of stability that comes in for at least the short to medium term. Longer term, I think the reality is that there's probably going to be more regulation that's going to be focused in, because this is a key part of the nervous system for the economy, irrespective of where you stand. And so I think there is going to be a little high level, kind of much more deeper review of this from where I stand.
Thank you, Yousuf. Bilal, I'll bring you in to sort of follow up on what Yousuf was sharing, right? In particular, we obviously, in the last few months, year or almost 2 years now, have seen the sheen sort of come out of the growth stage, technology era, innovation cycle, right? Both on the finance side, there were questions being asked on the regulation side around data. Countries like India and Indonesia have already been talking about that at the G20 level, for example, as well. That there's like a broad question mark around tech, and now this event happens. So what are you thinking about? What's top of mind for you in terms of the impact near term, but then more importantly, and I think we're getting some questions about this as well, how does this play out from here on out, given, as Yousuf said, not a clear playbook, but then also more scrutiny and regulations coming down the pipe?
So first and foremost, I'm not a macroeconomist, so I won't venture into that land and try to tell you how interest rates should or should not change. What I will say is a sequence of events as it's unfolding, is, and only taking the view of a startup CEO, founder, or a VC, is that we were happily going around trying to figure out if Q3, Q4 is going to see an increase in the economic output, or is it going to be a decrease? Is the interest rate going to continue to go up, or is it going to start to flatten out? We were in the very simple baby land when suddenly, you realize you're starting to get calls, and then you're starting to make calls to tell people to start moving their treasuries around. Now, I would argue that a majority of people sitting in Silicon Valley actually had not thought about treasuries to begin with. All they knew was that, you get money, you need to open up a bank account so that the VCs can wire money into that. You need to open credit cards, you need to open maybe venture debt lines, you need maybe working capital lines, and so on and so forth, right? And all of that was much easier done at one of these regional banks that understood technology, that understood a company that's not making, revenue, or certainly not making profit. The reason this economy works, the innovation economy works in Silicon Valley, and by Silicon Valley, I don't mean just the geography, but the tech sector, is because we are okay doing business with companies that don't have profits, that don't have revenues. That is not the case around the world. Try going out to a bank in Pakistan and saying, hey, I would like to get a loan. How easy is it to get a loan? Unless you have personal credit that you can bank the business on, it's very hard to do so. Whereas in Silicon Valley Bank's case, you could raise $5 million in venture capital and easily get another $2-3 million in venture line, and then, you know, obviously all kinds of other activities. That changed. I mean, obviously it all came to head Thursday last week, but it's been happening for 2-3 weeks. We've been having this conversation actually for a few weeks and months now, including conversation with SVB, that their messaging is not clear. But, you know, history is what it is. The reality is that everybody, as Yousuf said, we had to figure out how to get access to their money. That all changed over the weekend to, you know, on Sunday when it came out that Fed's going to backstop that okay, that money's going to come back. Now we need to figure out how do you manage your accounts over multiple banks, right? So it's easy for a VC firm to be able to say, guys, this risk is not worth taking. Just move all your money to a Bank of America, Morgan Stanley, or JP Morgan, or a Credit Suisse or a UBS if you're abroad, or Hong Kong, you know, HBSC. But you know two things. Number one, that the irresponsibility of that is that you're basically causing bank runs, right? When you have a portfolio of 200 companies in your portfolio managing billions of dollars. I mean, we had billions of dollars of money spread across this regional banks. You start moving that, you know, a single firm can actually make a difference. Let me be blunt about that, right? Like, so this is not a, you know, ordinary people at home making a decision. This is a large fund in Silicon Valley. If they make a decision to move out of FRB or SVB, you're talking about billions of dollars moving out. So when you read about, you know, some bank getting $20 billion, that's like 2 venture capitals portfolio worth of money sitting inside these companies. The second thing that started to happen was, if you go to large companies, you actually don't get all the facilities that you had access to. Try going to JP Morgan and asking for a venture line that's less than $200 million, right? Like, that's not, those banks operate at a different scale. You know, it's similar to, you don't show up at a multi-billion-dollar bank, multi-billion-dollar VC fund and ask for a $25,000 investment. I mean, they don't know how to manage you. They don't even know who to send you to, let alone give you that money. So that's the second problem that we started to figure out. You know, how do you have multiple accounts? And everybody became an expert in sweep accounts, and FDIC insurance rising to $5 million because you have, you know, 10, 15 accounts in the back end that are sweeping out of a single account, and all of that stuff that you can imagine a CEO is running a business and suddenly having to deal with this. The third thing that I think that issue is happening right now, but I think is fairly contained. The idea is, even though the Fed has not come out with a policy, and they can't because they need political approval for that, that they will bank stop all the deposits. The working assumption right now is that the deposits are going to be secured. Then the question is, still, with that in place, you still need to diversify, and what do you do and how do you do that? And I don't think the best practice is there. People are talking about having an operating account at somebody like an SVB and FRB, having a startup banking account like a Mercury or somebody that can move quickly, or Brex, or, you know, the Ramp, a bunch of other companies, Meow. And then you have treasuries on the other side. So you hold your most amount of your money in a large account in some kind of a federally protected asset. The third thing that everybody's dealing with now, which is the work that's going to happen this week, is really try to understand the long-term ramifications of this. You know, this is a political crisis. This is not just a financial crisis, right? This cannot be solved. Interest rates are going up, and, you know, sure, people would like interest rates to stabilize and maybe go down. However, that does not affect the average Joe Schmo sitting at their home. Cost of goods has gone up. Cost of putting food on your table is continuing to go up. You can only, as I say, hide behind changing the definition of consumer price index so far. You know, now Fed talks about core inflation, right? Taking out housing and other things. Well, okay, you can play those games only for so long, but I know that when I go to the store, eggs are expensive and milk is expensive. So how do you then figure this out? Interest rates needs to go up to bring those prices down, but interest rates going up, as we know, has created this issue in the financial and banking ecosystem. So this is going to become a political crisis. In the middle of all of this, we have a country that is, you know, in some ways not necessarily always making the rational decisions. Thankfully, last weekend, by the way, the political system really worked well, right? Like, we've got, like, within 24 to 48 hours, mobilization out of a problem happening at a regional bank that people think of it as, you know, small businesses in a small community and winemakers, to suddenly government acting within 48 hours and providing a backstop. Maybe the same thing happens and rationality prevails. And I think that's our hope that that's what happens. You're seeing that, across the world, that people are looking for signals on what really should be done here. And that's what people are looking for. The reality is the cost of capital is going to go up, right? There's certain kinds of capital that are just not going to be available, right? Certain kinds of, risk is not going to be taken. I think it affects, I can speak for myself, right? Like 2 years ago, if I went into my partnership and I said, there's this amazing entrepreneur, really like them, I think this is an area that's of real interest, growth economy, blah, blah, blah. I should make this investment in Pakistan, right? Now think about that in April 2023. They're like, wait, what are you talking about? So tell me more about the inflation in Pakistan. Like, and suddenly you have questions like 2 days ago, I read it was a 45% inflation rate, right? So you grow your company 50% on an international dollar basis, you basically you were flat in revenue, right? Those questions are going to be asked. That's going to make, frankly, investments harder to make around the world. People are going to go back to what people call quality of assets, or high quality investments, or whatever, safe investments, whatever you want to call it. And I think it's going to happen at every level. Now, for some people, that's going to be certain kinds of investments in the US. And it means different things to different people. There's going to be a barbell approach, which is what we are observing right now. There's assets that are, you're seeing Stripe raise $6.5 billion in 2 days. You're seeing Rippling raise $500 million in 2 days. You're seeing companies that are considered high quality assets at the right price are going to basically shore up their balance sheets. We're seeing that in our portfolio too. We have, some of our companies are sitting on significant amounts of capital because thankfully they're ready to basically utilize that over the next few years and consolidate the industry and so on. So you're going to see that. On the other hand, you're also going to see the barbell approach, which is, hey, I can make early investments that are not too many dollars at risk, but see how the game plays out over the next few years, so that I can be actually in the game. I can be actually helping build these companies, and 2-3 years later, when we're out of this cycle, hopefully, and the next cycle is up on its way up, I have companies that are ready that now look like really interesting Series B bets or Series C bets or whatever that might be. So I think that barbell approach is what I'm observing right now in the VC world. The missing link in all of this is that a lot of companies are unfortunately right now in the middle. They're not, seed stage startups, and they're not growth stage startups. And those are the companies that are going to have to thread the needle somehow.
Thank you for that, Bilal. And I think that's a great segue to you, Ahmed, Jalal, in terms of the view from the emerging market side, right? And the view from Pakistan and all of this. I remember last week, was talking to a few friends of mine that were getting calls, for example, from founders in India, expressing concern about what was going on. In particular, to Bilal, your point, right? This middle of the path startups where it was relatively easy to get access to financing. And their question was, well, are we going to do that? Because there's obviously a lot more pain in the valley and beyond. So Ahmed, what are you observing and things that you're paying close attention to in terms of the fallout of this banking crisis and the events leading up to the collapse of SVB? And then what do you see happening or think are going to keep an eye on in the next few weeks as this plays out, as somebody who's looking at more on the EM side and on the Pakistan side of things?
Thank you, Uzair, and it's great to be part of this panel. I think whatever happens in the US on the financial side, we saw in 1998, we saw that in 2000, 2008, it's multiplied multiple times in emerging markets. When the US suffers, there's a financial loss over there, there is a flight for quality. And which basically means that every EM investment is pulled back. It pulls back within the US to what they know, and the risk appetite goes down. Fortunately or unfortunately, the biggest institutional capital market in the world is the USA. So when the money moves, both on the positive side, so when you had a lot of interest of US investors in Pakistan, I would say that was not all positive, because some of the money went into deals that should not have been unfunded to that extent. There is such a thing called an overfunded startup or too much capital slushing around in an economy, and I think that happened in Pakistan, and I think that distorts the incentives. But of course, when the reverse happens and that money is pulled out, there's a huge effect in terms of funding, in terms of job losses, in terms of collapse, and I think we're going to see it play out over a period of time. But I think let me draw out, because And formerly, I've been an investment banker. Then I was a private equity investor. I was an operator, and now I'm in VC. So this has happened before. 5th December 1996. We know a gentleman by the name of Alan Greenspan. He made a speech and he called it irrational exuberance. So we've been there before, Salman, we've been there before many times, that there was irrational exuberance, and what happened in 2000 was a result of it. I think what we saw in COVID was irrational exuberance. We saw that Silicon Valley Bank's deposits increased by 3 times in a short period of time, and they didn't know what to do with it. And frankly, they made a wrong bet, long duration treasuries, and as a result, they've made losses on that. But I think what we see as Silicon Valley Bank collapse or near collapse of it, I think it is going to be replicated across VC in the Silicon Valley. A reason why is the Silicon Valley Bank is just the starting point of it. They've just materialized the losses from a huge portfolio that they had, and they didn't know what to do with it. The same problem, by the way, is also with the VCs in the Silicon Valley, who've taken in a lot of money. Some of the investments that they have put in are not in the right places. Think about it like US treasuries, but that is being marked to market. Some of the VC investments are not marked to market, but in a year's time, and 2 years' time, a lot of those losses are going to materialize. And I think we're going to see the similar kind of fallout in VCs. A lot of them will close down shop because they raise too much money. I think it was a good problem to have, but there is a limit to how much money you can take and how much money you can deploy. And I think the deployment side of it, people went a bit over the board on it. I think if I take that problem into Pakistan, I think what happened was, again, there was a case of irrational exuberance in 2000, 2001, 2022, early part of it. And I think what it showed we are people who are very prone to irrational exuberance, what we call believing our own propaganda. So there has to be very tight governance and control on us. We do talk a very good story and very convincing story, but that story has to be embedded in reality and has to be held down with very strong corporate governance. And unfortunately, some of the VC funds, and probably coming from abroad, did not have either the knowledge, the understanding, or the governance mechanism to hold down founders or companies to high standards of corporate governance. And hence, money went in different directions. It hasn't done the work that it should have done for Pakistan. And I think what has happened as a result of it is that a lot of money has, not gone into value creating activities that it has done, that it should have done for a society, for an economy like Pakistan. And what the first lesson that we have learned from this, and I think it's going to happen, we have already learned, is operations matters. That just knowing strategy, just knowing terminology is not sufficient. That founders with subject matter expertise, who have been there, who have run logistics, warehousing, rather than from some other background and have some connections to have raised the money, they do much better. So that is probably one thing that that has already happened before SVB, that there is a flight towards those founders or the quality founders who are much more operational, much more hands-on, and less tech focused in that sense. The second thing that is going to happen as a result of SVB is that treasury matters. CFO matters. It's not all about product manager. So there's this whole glorification of this role called product manager, and product manager could save the day because it's all about growth. But actually, in our markets, what's more important is cash control, cash management. That's always been the case. Tech fundamentally doesn't change anything, the fundamentals of finance. That good cash flows need to be managed, leakages need to be controlled, treasury needs to be managed. Anyway, even in Silicon Valley, it's not right to say that the CEO should not know the treasury aspects of it. It is his business to know it. I remember Jeff Skilling of Enron saying in his testimony, I don't know, I don't know mark-to-market accounting. And what does that mean? But it is his business to know what those things are. And these are things that are very important, because ultimately it's not about, tech in the long run can can earn you, huge valuation, but ultimately in the short run, cash flow is important. So that's the second thing that we're going to find out, that traditional roles like treasury, like CFO, are going to become more important in startup. And the third thing of that is going to happen is that tech has going to become a bit more boring from what it has been, and a bit more boring in the sense is going to become a bit more grounded. Real tech value creation is not about breakneck speed growth. It's about improving the system, digitizing the local system, and I'm talking about in context of Pakistan, where the technology is not. I would say it's an incremental technology that we are deploying, or we are digitizing existing physical infrastructure. That kind of excitement is going to go away from it, and it's going to become more grounded. Those businesses that are more rooted in reality of economy, the infrastructure that we have, are going to do very well. They would probably take 5 years or 7 years to get where previously they were planning to get at the end of 1 year or 3 years, but that's what's gonna win. So that's the third thing that's gonna be important. I think the fourth thing is some of the regional investors, and I wouldn't name them. One regional investor that invests in Pakistan at the place at $200 million worth of capital or worth of deposits in Silicon Valley Bank. They invest in Middle East as well in Pakistan. And I think that money being stuck, or that money having a setback on that money, or taking some time for that money to come through, will definitely mean that less of this global money is going to find its way into countries like Egypt, into Pakistan, or into the GCC. And I think that's not a bad thing. I think it could be a mixed bag. And the reason why it could be a positive thing is there's a lot of silly money that floats around that creates unnecessary competition, and that bloats up asset prices, that bloats up value of talent, and you end up wasting a lot of money because you have to compete with someone who's raised $5 million or $10 million, don't know what to do, and just going and throwing that money around. And I think that thing, when the money that died, that goes back, I think that will be overall positive for the quality founders, quality startups, more grounded founders, and more grounded business models. I think these are some of the things I can add more, but I'll push it back in your direction, Uzair.
Thank you for that. And I think that was really good context in terms of things in Pakistan. And I actually agree with you in the sense that being a bit boring and grounded, especially in a high inflation environment like Pakistan, right, and having good governance and controls on cash flow is the way to go, given where the domestic economy and the political cycle in Pakistan is. But Salman, I want to come to you. There's a couple of questions here. And I think a few of the panelists also hinted at this, right? This is not over. We're now not out of the woods. Two questions that I have taking in from the chat as well. And for those tuning in, send more questions in if you have them. I'll ask them from the panelists. One, what is the risk of contagion here, broadly speaking, right? Tighter monetary conditions, manufacturing sector, other areas where this can bleed into. And then two, is there, in your mind, what is the likelihood of there being another Lehman Brothers type moment coming down the pipe, given the fact that the Fed still seems to be hawkish in its intent? And the odds are that I think they're going to continue down this path to, in a way, at least my assessment of this is to pop some of these asset bubbles and misallocation of resources and fix that. What are your thoughts on contagion and sort of Lehman Brothers type risks in the market?
So let me start. I think Lehman Brothers type risk is pretty low. I mean, the big banks, the G-SIBs, are quite well capitalized. In fact, they are the ones who are going to be under pressure to rescue some of these smaller banks. So we saw the deposit with First Republic Bank come through from the big ones. Every crisis is different, although there are some similarities because obviously there's a banks involved there, but every crisis has its own nature in terms of how it pans out. So this one is certainly focused on the regional and smaller banks. So just let me give you some numbers. So the industry is $31.4 trillion. Half of that sits with the big banks in terms of assets. Then the other half sits with the smaller and mid-sized banks. So around 3,500. There are around 3,500 banks which have up to $10 billion of assets. And then there are a number of banks, I think, if I remember, I think 250 or 260, which have around 10 billion to $100 billion of assets. Those are the ones which are under scrutiny now. I understand SVB and it started triggered from that, but it's going to become much broader. So if you're so First Republican has nothing to do with Silicon Valley or tech startups or anything like that. It's basically more well-to-do depositors who are thinking that, why should I take that risk, basically, even if, ultimately at the end of the day, protection will come through. So the problem is that Ms. Yellen has said that the unlimited depositor protection will come and will be driven by the Fed and FDIC on a case-by-case basis. Now, that's a very important thing to understand. This is not a blanket protection. So luckily, the SVB was the first in the chain. Luckily, if it was in the middle of the chain, you would have a very different conversation. This could have been triggered by any bank, frankly speaking, because the SVB is not the only one which was doing bad risk management. There are quite a few of them there. So obviously it goes back to then this political side, as you mentioned, the pressure on why the Fed has gone so aggressively, why regulations were eased in 2018 for these mid-sized banks. The stress test which was done for SVB was just testing them for from interest rates going from 0 to 2%, while the big banks have to do it from 0 to 7. So there was a significantly different regime which was in place. So this contagion can, as I mentioned earlier, can only stop if, firstly, has to be more pain. That's what the learnings from Lehman is, which is that there has to be, the system reacts. It's not preemptive or proactive as much as it should be. So it will react to more pain, and ultimately the solution would be some kind of unlimited deposit guarantee. And some of the regional banks are already asking for 2 years. And they are saying, okay, we will accept higher regulatory, burdens. We will accept, higher fees, and you give us this 2-year, 2-year protection. If this comes through, this means some of the lines and the credit lines we're talking about, they're gone. So none of these banks are going to give any credit to anybody right now because they have to replenish their capital ratios. So it goes back to the foundations of the whole thing. There's also scrutiny as a result of SVB, why it was doing mixing equity with debt markets. Venture capital, whole industry is not amenable to debt markets because you have zero cash flows. So it's a dangerous thing to do anyways. It is an equity it's equity play, right? I mean, from an intrinsic perspective. So we're mixing it with banking has its consequences, and obviously we are seeing the idiosyncratic issue with that. So to answer the question, I think this is going to spread because of this trust deficit. This is nothing to do with now anybody about whether you're a tech player or not. It's about somebody who has deposits, who has above 250K, who thinks, why take the risk? Why shouldn't I just go to JP Morgan and Bank of America and sleep easy at night? It's as simple as that. So it's a confidence shock at its core. And the only way it can be short-circuited by unlimited deposit guarantee, which can be provided by the government. But what cost? What is the moral hazard? Will they put people in jail now? All those things will become political now, and it has to be addressed. But that's how I see it.
Yeah, thank you for that. And I think the accountability part will obviously come. In fact, there was a question here about accountability for people like Peter Thiel and others who took their money out first and started the bank run. We'll get to that in just a minute. But Yousuf and Bilal, I think you both had a consensus, and I think Ahmed agreed as well. Risk premium is going to go up. The way in which money flowed to markets like Pakistan is going to be much more challenging. Bilal, you said you get questions about inflation. Some of my work, even I'm getting questions about companies that source from Pakistan asking about supply side shocks and whether they should begin to think about diversification of their supply given what's coming down the pipe, right? So it's not just in the tech sector, it's broadly speaking. A lot of folks with exposure to Pakistan, even on the manufacturing side, are thinking about what comes. But my question to both of you, maybe Yousuf, you can start and Bilal, you can jump in, is if you are a founder and entrepreneur sitting in Pakistan, how do you then think about sort of, making a case for another round or investment in the country, given the dynamics, not only in Pakistan, but in the Valley and the tightening credit cycle? What would be some of the things that perhaps, building on what Ahmed said about you should, have better operational experience, strategy won't cut it alone. What are some keys that, founders and startups and entrepreneurs should think about in this cycle right now?
I think I said this at the Paklaunch event in Dubai. I think, this is the time to kind of demonstrate fortitude more than anything else. And I think that's absolutely critical for any company that's going to be invested in it at this stage. Typically, specifically in Pakistan, it's a large investment and bet on the team. And so being able to talk about that team and the ability for them to be able to execute and show a level of grit, that is important from a signaling standpoint. I think the second piece is it's very important to be able to talk about the structure of the business, both in terms of what you've built and the robustness of it. And then the second piece is how you were able to basically navigate and kind of focus towards building up both your revenue, but be able to actually protect your balance sheet. Being able to react to market needs is it's a daily thing for startups. So I think that, I think it's very important to kind of point out early stage companies, these are, they have no shortage of challenges on a daily basis. It's not like, well, there's one macro event which it may affect them a little bit more, but, to Bilal's earlier point, the focus is, can I meet the quarter? Am I customer successful? Am I deploying our product? Did I meet this deadline, etc.? So, the quality companies are the ones who are able to actually both, have a degree of robustness in their platform, but also be able to see where they can accelerate growth. One thing you have to remember is the technology industry rapidly changes in terms of the transformational technology that's available to them to be able to platform. I don't want to go down a generative AI kind of, rabbit hole, but the reality is you're seeing some really seismic shifts in technology, because that is ever changing. It's irrelevant to a certain extent of what's happening in macro. Innovation is still happening at the very, very core. And that has impact and is an opportunity for founders to be able to adopt, to be able to either provide a much better product or a new product offering, to be able to operationally build much more efficiency in their kind of operational infrastructure, or to be able to actually just take the company to the next level. So, the kind of rigorous focus is going to be absolutely key, at least from my standpoint.
Thank you. So Bilal, before you jump in, just as to add on to this, right, because we got a question here as well on related to one, the point that tech will be boring, and perhaps Ahmed's point, boring is good in this context. One, do you sort of feel the same way or not? And then also the question is, how does one market boring? And if you can just share your thoughts on that as well to build on what Yousuf said.
Yeah. So, taking step back just a little bit, sitting in, United States tends to have an oversized influence on the world. So on one hand, the world is becoming a little bit more bipolar. It used to be a single superpower, but we're starting to see a little bit of, diversion from that. So Pakistani startups will have to also choose its friends and figure out what to do. I would like it to choose US. I'd like it to align itself with the West and Western investors. But I can tell you that I was getting called from the national security agencies telling me that, hey, on Friday, I was getting this call that they're already starting to see nefarious actors from those states that are not friendly to the US, starting to make inroads and trying to put money into US-based companies, acquire IP, small companies. So, some of those could be friends to Pakistan or Pakistani companies. You will have to choose your own, who you want to be friends with, but that would be available. Okay. I would encourage you to not do that, but that, I know founders will be looking at, China is suddenly more attractive than US in terms of investments into some companies. The second thing is that we're sitting at a very unique juncture. It's not just, somehow we didn't pay attention to 0 to 2% or 0 to 7%, which was really well stated by Salman, that there's risks, different levels, people take different kinds of risk or are allowed to take different kinds of risks. And perhaps startups never had to ask anybody for any allowance. So they take as much risk as they felt like taking. But we are in a situation where we have a war going on in Europe. Let's not forget that. There are thousands and thousands of people dying every day. We just kind of shrug our shoulders and move on. We're not done yet with Iraq, right? We're not done yet fully in the instability that exists in Afghanistan. If anything, Pakistan is politically highly unstable right now. I open up the newspapers in Pakistan and all I read about is whether he's going to court or coming out of court, whether he has 100 cases on him or not. And is this government going to, nonsensical statements about, for the last month, I can tell you every day, IMF deal will be signed in 2 days. It's $1.1 billion. There are probably people walking around in cafes in Palo Alto who can give you $1.1 billion, right? There's a serious issue that's happening around the world. We have a conflict with China. There's, Saudi Arabia and Iran signed a treaty sitting in China. That has ramifications as well. So I think there's a lot coming at us right now that we're trying to address, not just interest rates and inflation. In the middle of all of this, you talked about boring. I would change that word. It's not boring. It's actually what I called it yesterday, and I said it publicly. I've been thinking about it for a while. It's responsible investing. Okay. The idea that something, when you have free capital and you can give that money away to people and you can acquire customers with negative gross margins and negative unit economics, that might sound exciting for a while, but you can't make it up in volume. We all know that. The founders who were building these companies knew that. They knew it in the US and they knew it there, right? My Uber rides to the airport from Palo Alto used to be $30. They're about $70 now. Right? There's a reason for that, because suddenly they realized that as a public company, they have to show some kind of profitability. There were people in Pakistan, there were companies, the ideas that did not work even in the most developed economies, they were being tried out in Pakistan because, hey, why not? Because it was irresponsible investing. The idea of starting a business was more interesting than actually building a business. Okay, so I think what will happen is that people will start to think the way to market this is to talk about responsible investing. Responsible investing, when I said that yesterday, I got, hundreds of comments. It's not about investing in energy and climate and manufacturing or only healthcare companies. No, it's not that. You can build a gaming company, but you can build that company responsibly. Okay? You can start thinking about economics, but you can also start thinking about societal impact. TikTok in the US is really a Chinese spyware, right? But in China, kids are not allowed to use TikTok. Or in fact, if anything, they can only have educational content, and that also for like a certain number of hours per day, right? So they are, whether they're a responsible nation or not, but they are implementing top-down certain regulations. They cleaned out certain industries. If you're an ed tech company in China, you don't exist anymore, right? A lot of big construction companies that were, building out fake cities or actually empty cities have been wiped out. Right? They fixed that top down. We in democratic places have to do this bottoms up. So I think you will see a pushback. We are feeling that pushback right now in Silicon Valley, right? We are seeing that tech used to be seen across the world as enabler of jobs, enabler of technology that connects people. It allows us to communicate. Look what we're doing. I did not spend a single dollar having this communication with you live on video. When I came to this country 27 years ago, it used to cost me $4 a minute to call my mother. Just on a phone, right? That's what technology was seen as, a power of doing good. It has turned into, essentially extractive capital, extracting money out of the economy. Right? It's what we say about politicians in Pakistan. This is what's happening to tech around the world, and I think that needs to change. It's that can change. There's no shortage of problems. I think people will need to start thinking about how to build sustainable businesses. They could be small businesses and grow. The cockroach entrepreneur idea is going to become more popular rather than the flashy headlines. Every day we were reading about another company in Pakistan raising 5 million, 10 million, largest seed round, largest Series A round, largest Series B round. The emphasis went on the larger, right? And I think we saw that story in the US a few years ago, and that did not end well, right? So I think that is changing now. And the last thing I'd say, what Pakistani founders need to think about is that for the last 2 years, all the pitches I got from Pakistan, and rightly so, and of course I'm generalizing here, a lot of it was like, we have this growing population, we have a young population, we have this economy, we have everybody speaks English, everybody has mobile phones, and so hence we are servicing the local economy. I think we will have to start thinking about servicing the global economy. We will have to start thinking about what is our unique talent base? What do we have in, the large population that we have? We have tremendous talent. I think if we can give them access to international markets, if we give them exposure to international markets, if we give them the ability to compete at an international level, we're not going to have turtles all the way down kind of companies.